right. Happy Fed Day, everybody. 25 basis points. Okie 25 basis points has just hit the tape. Moments ago, interest rates have been raised. Markets have been, they were down, then they're up. We got the algorithms are arm wrestling right now. And right here on this channel, we let the algorithms arm wrestle when the algorithms want to arm wrestle. I don't get involved in that noise. I wait for the dust to settle before I do any trades. I am not at all trading whatever is going on right now with the algos. I'm just sitting back right now, waiting to see what Jay Powell has to say, looking for a couple of key phrases from him today. I'm looking for some clues about how much higher do they consider where they would pause? Maybe not the pivot. No talk of lowering rates yet, but when will the pause? It seems a lot of people are starting to say May. May is when they might pause. Now, does that mean another hike in May, or does that mean at May, no hike? We'll listen for some clues today. I think one more hike of 25 basis points after today is pretty much baked into the cake, barring some catastrophe hitting. The question is, do we get 2 more 25s before a pause? Do we get 3 more 25s before a pause? And what about quantitative tightening? It's now been a couple of months since anybody has mentioned the Fed's balance sheet at any of these press conferences. And, you know, the mortgage-backed securities and the U.S. Treasuries on the Fed's balance sheet that they have supposedly been rolling off at a pace of, $97.5 billion a month or some number like that? Well, they haven't really mentioned that in a while. All the focus has been on the rate hikes. Well, QT, that's a big issue too. So will Jerome Powell say anything about that today? Well, who knows? And before we go anywhere, I got to send a shout out to Jake's Custom Parts, who says, boring. I wanted 50 basis points. Well, Jake, I think the market would have flipped its proverbial lid had Jay Powell hiked by 50. And I say Jay Powell, it's the whole FOMC. He's not the only one. He's just the figurehead. 50 would have sent markets lower in a big way. So, maybe some of you bears would have been happy to see that. That one, I think 25 was pretty much baked into the cake. Nothing unexpected has happened yet. The question is, what does he say? And that's why the press conferences are always so important. Because Jerome Powell, he can move markets just with the tone of voice. Just if he accidentally lets that one gargantuan fuzzy caterpillar that's parked above his eyes move up or down a little bit when he says something, it could move billions of dollars. It's not supposed to work that way, folks. But this is the system we have. Central bankers, the Fed put really dictates which direction the markets goes. This is pretty far from a free market. But it is what we have, and we got to play the hand we're dealt, and that's why this is so important. This really does affect you guys. The biggest fraud or the biggest misunderstanding the average person has is they think what is going to be said in the next few minutes will not affect them. That is definitely not the case, folks. What is going to be said in the next few minutes will absolutely have a direct, huge impact on your life, right? Anybody who lived through 2008, 2009, you think the Federal Reserve wasn't a key player in that? Oh, yeah. Anybody who lived through the inflation of the 1970s, I know they blame the oil embargo, but you better believe the Fed was a big, big player in that deal. And then anybody who went through the economic contraction under Paul Volcker and from his rate hikes fighting the 70s inflation, you better believe that affected the lives of everyday people. Even if they thought those things that the Fed and the central bankers, I don't really understand what they are and what they do, but that doesn't affect me. That just affects the rich people. Oh, no, folks. This is a direct player in the quality of your life. We have had 21 consecutive months in the United States of negative real wage growth in this country. 21 consecutive months. For almost 2 years, while they've been talking about transitory inflation and soft landings and strong labor markets, our lives have been getting more difficult. The financial hardship of the average person has increased dramatically over the last 2 years. Due to inflation and now due to interest rate hikes. So you better believe what happens now affects you. And that's why you should be sharing this video, even with those people who say, oh, no, I don't want to hear it. I don't care what happens at the Fed. That's just for the rich people. I don't do that. That affects them anyway. Just because you ignore it does not mean it doesn't affect you. And that's why I am so passionate about this. And that's why I include the hashtag and the Fed in virtually everything I put out on this channel, because they play games with our lives. And Jose Orozco, thank you, sir, for the super chat and support of the channel. Keeper of the Bucky's Corn Nuggets over there. He says, Jack, do you think Jay Powell will claim strong labor market? Oh, Jose, it is not a matter of if. It is a question of how many times will Jay Powell lie to us and tell us the labor market is strong. And hey, for you guys who like to do little drinking games or take some action every time some stimuli is presented, why not use every time Jerome Powell refers to the strong jobs market or tightness in the labor market today as your trigger for, because he's going to say it. He's going to say it a lot. And that is not true. We do not have a tight labor market. The API jobs report came out today and said the economy added only 106,000 jobs in the month of December. That's the lowest in 2 years. And don't forget something I've been pounding the table on for days now. The Bureau of Labor Statistics last week very quietly reduced the jobs added in the United States in the second quarter of 2022 from positive 1.21 million to negative 287,000, a swing of 1.4 million jobs to the downside. There is no strong labor market. And as 21 consecutive months of negative real wage growth will tell you, that's the case, right? Real wages would not be dropping if there was a shortage of labor. As my friend the Happy Hawaiian has put it, we have a wage shortage in this country, and that's why labor is getting cheaper relative to goods and services. We don't have a worker shortage. We don't have a tightness in the labor market. Quite the opposite. Very good point, Mr. Jose Orozco, and thank you, sir. You are a gentleman and a scholar for the support of the channel. I got my man. Did I miss anybody? I got Mike Binder from Robin RC Model says, buckle up, Jack. See if Jay Powell smiles or say pause. Pause will be a big one. If Jerome Powell says pause, go look at markets. By the way, look above my head here. We have got a couple of charts. We're going to be cycling through the S&P, the Dow, the NASDAQ, the DXY, which is the U.S. dollar relative to other global currencies. I also got gold, silver, and the 10-year Treasury. So as Powell is talking, you're going to see these charts changing. Look for reactions to specific things. And Mike Binder, good point. If he says pause, if he says, I intend to pause in May or pause in March or April, then you're going to see these charts start to move when that happens. Thank you, Mike, for the super chat and the support of the channel. And thank you. Freedom for All says, remember, he's blocking me here. I have to jump above it. Remember, income tax was only supposed to be for the uber wealthy. So much for that complete lie. Good point, Freedom. What was it, 1911 the income tax rolled out, or 1913? Right around the time the Federal Reserve was created. Only the wealthy were going to pay income taxes. And now, almost half of everything we do goes to the government in some way, shape, or form, be it federal, state, local, or some fee or some surcharge added to your phone bill or your electric bill. Everything we do goes to the state. Why not? Thank you, Freedom for All. Appreciate the super chat. Guys, you're being very generous today. I appreciate it. Thank you very much. And we are just a few minutes away from Jay Powell. We got about 7 minutes before the press conference starts. I got my man Mish is here. He is lingering in the background right now on audio. The ever-present Mish the Mystic is hanging out. Mish, how are we doing today?
Man, I'm doing great. How are you today?
Well, my blood is pre-boiling, all right, because the Fed, I usually get a little, you guys might see some veins sticking out of my neck.
Boiled. You can't boil if you're already pre-boiled.
Yeah, I'm pre-boiled. I'm excited because the Fed press conferences, you always get a decent amount of views. There's a lot of energy around the channel, but at the same time, the things they say just so get me under the skin. And let's ask you, go ahead. What are you thinking today?
Well, I'm thinking two things. One, you said earlier you think one more raise. If we follow the dot plot from September, you have one more 25 raise, right? I think it's going to be two 25s back to back, and then they pause. I want everybody to understand this pause is going to take like 6 months. This isn't pause, start lowering rates, right? Plus, you also have the tightening of the balance sheet. You have that going on too. Secondly, unless we see something like a Jackson Hole type J Powell, I think the markets are going to just cruise along.
At Jackson Hole, that's referring to the meeting they had, I believe, was it Mississippi? I don't know where Jackson Hole is.
Middle of August, they did this meeting in Wyoming, some economic, and J Powell came out and just, sorry, ladies, whipped it out and starts beating people with it.
Yeah, that's when the market was getting a little frothy, and Jay Powell said, stock market, no, back down you go. And he slammed the brakes on the market. The market's a little frothy right now. A lot of optimism in the market. So
it is. I think that the longer we go, the more and more people are calling for either a pivot or a pause. I think the volume has to be a whole lot louder before any kind of pressure is put on J Powell. And I saw, I was going to say 2 more super chats came through.
Yeah, well, I got my man Mike here. He says, let me also write a longer text so we cover you for a few seconds more. Should I just hide below it? Yeah, you're covering up my my Superman jaw here. He says, keep up the good work. Gonna get ugly sooner or later. No, Mike, I am gonna stay pretty forever. Oh, you mean the markets are gonna get ugly sooner or later? Oh, I thought you were talking about me. I don't know about you guys, but I intend to be beautiful forever. Let me have my fantasies. Let me have my delusions, all right? I work hard for you guys. Indulge me. Thank you very much, Mike. Appreciate the super chat, sir. I appreciate you. The support of the channel, everything you do. By the way, Mike is one of those guys who is just always scouring the web looking for stories. If something breaks in the world, I get a message from Mike within minutes. I got a couple of folks who do that out there. Mish, you're another one that does that. It's fantastic. This little, I'm almost going to say like an intelligence network that has sprung up around the channel. And Mike, you're a huge part of that. Thank you so much for everything you do to help the channel, brother. And thank you for Cesar. Am I saying that right? That X right after the C. That's tricky, man. Is it Cesar? Caesar? El Caesar? He says the impact on Bitcoin. Do you want a Discord built for you? Oh, my man Mish already built me a Discord. You'll see a link down below. There is a link to my Discord that Mish runs for me. Very nice. Thank you. By the way, shout out to my Discord guys, also part of that intelligence network that I mentioned. And impact on Bitcoin. Bitcoin right now, there's so much froth in the Bitcoin market. We got a couple of minutes before he starts talking. Bitcoin will probably move inverse to the DXY. So if we see a big drop in the Dixie right now, we'll probably see Bitcoin go up. If we see a big rocket up in the Dixie right now, we'll probably see Bitcoin go down. But remember, Bitcoin is not just a play on the dollar right now. Bitcoin is also a play on the widespread fraud in the crypto space, not the Bitcoin space, in the crypto space. There's still a lot of that stuff is unraveling. A lot of that stuff is going bust. My gut tells me the bottom is not yet in for this cycle. Although if you look at the calendar and the halving cycle, we are within a matter of days where historically we would find a bottom. So that's something to keep in mind. The time to buy Bitcoin is not when everybody's saying get rich buying Bitcoin. The time to buy Bitcoin is when everybody is saying you'll get poor buying Bitcoin. It's happened before. It's probably going to happen again. Thank you, Caesar, with a weird X that I don't know how to pronounce it or not pronounce it. Is it silent? X is usually silent. King Xerxes. But thank you, Caesar. Appreciate the super chat, sir, and the support of the channel. And I believe I got everybody. I hope I didn't miss any super chats. We are just a few moments away from Jerome Powell talking. Let's check in over at the Fed and hear what we have. Let's see here. We got some groovy mood music playing over at the Federal Reserve. Isn't that just lovely? We're going to cancel that noise right now because I do not want to be put to sleep while I'm being robbed. No, thank you. And folks, I just want to say, when I say I am being robbed, why do I say I am being robbed? Because the Federal Reserve printed trillions and trillions of dollars in the 2020s. That was robbing money from existing currency. If you had money in a savings or in a checking or in a money market, the money they printed, the value behind that money came from you. They stole that from you. They robbed you. They gave you a couple of pennies on the dollar in your mailbox. They called it a stimulus and they said, you're welcome, but you lost money on that deal. They gave it to their buddies in big business, their buddies at the banks. Now the Fed is saying, uh-oh, we've got inflation. Prices have risen. Your quality of life is going down and your employer's about to give you a raise. Real quick, we better kill the job market to make sure the melonheads don't get a raise. And that way we can stop inflation after it's already made us rich. Remember, the Federal Reserve governors sold their stocks in August of 2021 to eliminate the appearance of a conflict of interest conveniently right before they turned off the easy money train and crashed markets.
Hey, Jay Powell's 1 minute, and we have 2 super chats.
All right, we got the challenged investor is here. He says this battle between Powell and Lagarde, rates to 6+. You know what? The European Central Bank, I don't think they have much staying power in this rate hike story, to be honest with you. I don't think they're going to make it. They got off easy with their winter being a mild winter, and I just thank you, the challenged investor, sir. I appreciate that. I don't think Lagarde is in this race for much longer. They're going to pivot pretty soon. And Freedom for All says, Gigi is better than you. Well, she is, and she knows it, but you know what? We don't need to advertise that, guys. Hi, Gigi, if you're watching. I love you, honey. And by the way, hi, Mom, and hi, Dad. Thank you, Freedom for All, for the reminder. I love you guys. I know Dad is in the chat today. I saw you there, Dad. Don't think I didn't notice. And all right, Jay Powell is here, folks. He hasn't come out yet, but it looks like the presser doth begin any moment now. Again, we are looking for clues about the pause, when they might pause. We're looking for clues about the pace of future rate hikes. Will we get one more, two more, maybe more than that? Is he going to refer to the tightness in the labor market and how many times? And if you want to go ahead, every time he refers to the tightness in the labor market, we'll see what that results. I don't advise it. I don't advocate that kind of behavior. And here is Jerome Powell.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Short comments from Powell today, surprisingly
Chris
brief.
Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you
Same
for
five
taking our
people every
questions.
month.
Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. we expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Except the labor market isn't that strong, Jay. Sorry.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index.
Oh, not this garbage again. Somebody's cutting my feed. They don't like what I'm saying, or maybe just convenient technical issues over at the Fed.
Recently.
There we go.
I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
These tech issues, you got to love them. This is the Fed's website, folks. This isn't my anything. This is the Fed's website lagging. But EC 660, yes, we are in a recession.
Is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly, and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
So he just left on the table 2 more rate hikes. That was important. I don't think the market's going to like
Connect
that.
a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for 2 sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is, research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization, in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury,
So much for the independent Federal Reserve.
I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina, and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're going to write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
That was Powell's poker face. Give away nothing about future
Steve
actions.
Leishman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up.
Did we just catch a transitory in
That's
there?
really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible, and then we would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael?
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year, and that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence
So
metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job, and it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Edward?
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. You know, so we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, you know, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, you know, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
You know, so my forecast and that of my colleagues, as you will see from the SEP, and I mean, there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. You know, if that happens, if inflation comes down much faster, you know, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
A lot more questions than usual.
Thank you, Chair
Shorter
Powell.
comments,
Simon Rabinovich
more
with
questions.
The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, and we have inflation moving down. Into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time, but we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Nancy.
Hi,
Chair Powell. Nancy Marshall-Genzer with Marketplace. Wanted to go back to another thing that Fed Vice Chair Lael Brainard said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, you know, once you see it, you have a serious problem. That means that effectively in people's decision making, inflation has become a really salient issue, and once that happens, that's what we can't allow to happen. And you know, so that's why we worry that the longer we're at this, and the longer people are talking about inflation all day long, every day, you know, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are, you know, we pick that up in conversations, and I've seen some data too that show people are, you know, gradually, they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and, you know, high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even, you will also see a boost to sentiment, I hope.
So if there's no wage spiral, why is he keep hiking? Why is he trying to put people out of work?
That's at the very heart. It's consumers and businesses that, you know, essentially, we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, you know, and I think that's very reassuring. I think, you know, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way, it's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I mean, I'm not going to try to persuade people to have a different forecast, but our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer, but we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk, you know, the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. You know, we of course will monitor money market conditions carefully as you know, as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up. And we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
All right. Well, I thought that would never end. My goodness, I got a lot to say about that. I got a lot on my mind. I got a big axe to grind with a couple of things. First of all, everyone in the world right now, or at least everybody who follows finance right now, is probably out there Googling core non-housing services to figure out WTF Jay Powell was talking about, because he mentioned core non-housing services 5 times that I counted. 5 distinct mentions of that, and that's important. And I think that's one of the reasons why. Check out this move in the DXY while Jay Powell was talking, because Jerome Powell gave us the data point that he's watching, that when he sees that, that is when pivot. All right, so we finally have the number to watch. It's not unemployment. It's not even CPI. It's not oil prices. It's not food prices. It's non-housing services inflation. And I'll be honest with you, right up until I've never heard that phrase used by Jerome Powell ever. I'd have to go back. It never jumped out at me, but he said it 5 times today. He finally gave the market a clue. And you know what the market values above all else? The market likes certainty. And Jerome Powell finally gave the market a little bit of certainty today. And, by the second or the third time that he mentioned that, that's really when the S&P finally really started to take off and when the Dixie really took a dive, right? The dollar really weakened right now. So the dollar market, the stock market, precious metals, the bond market, even Bitcoin, everything is saying this was a dovish Jerome Powell. And they loved it. They loved it a lot. Now, my personal opinion, I think the entirety of this move we're seeing right now will probably be gone by tomorrow afternoon. Call it a hunch. I've seen it before. You guys know I talk about it. That's why I don't trade Fed moves. I would not be remotely surprised to see this whole move in the S&P 500 just wiped out. Heck, it could be gone within an hour, folks. We've got Meta earnings coming out after the bell today, Facebook earnings, right? That's going to be a big indicator of the health of the economy, because Facebook earnings, that's marketing budgets, right? And let me just tell you, because I'm going to let you in on a little secret, I am in the advertising business. That's how I make my money with this channel, right? I do finance content. I try to put out the best content available. Hopefully I reward you guys for the time you spend watching me. But what do I actually sell? What is my product? My product is you awesome people. You are my product. I sell your time. That's why I value it so much, because it is my product, your time. And people are paying a whole heck of a lot less for your time right now, folks. Advertising budgets are way down, and that means the economy is cutting back. Businesses are reducing their spend. They're playing defense. We're going to see that in Facebook earnings. Okay, so that's one thing. This whole move, it could go up in smoke real fast, folks. It could go up in smoke real fast. But that Hey, Mish, what's up? Go ahead.
Yeah, so I really focused in on was that he talked about multiple rate hikes.
Yeah.
So I think he kind of squashed that a little, that on the table right now is 2 rate hikes, if not a third.
Yeah, he left that open. I thought that was big too. But the market didn't care about that, did it? I mean,
not a bit.
The market ran. That's another reason why I think we could see this evaporate very quickly. I don't think people really paid enough attention to that. All right. I mean, he did say we're committed to getting the job done. Ongoing increases will be appropriate. He mentioned consumer spending is still expanding at a subdued pace. That's a misleading statement, because consumer spending, if you adjust for inflation, is down sharply. All right. Consumer spending nominally is up. We are spending more dollars as consumers, but we're getting a lot less stuff for those dollars. If you adjust for inflation, even the artificially low CPI inflation, then consumer spending is dying. It's contracting hard. Case in point, Bed Bath & Beyond going out of business. All the layoffs we're seeing, even in consumer products now. So consumer spending is not just expanding subdued. Consumer spending is getting clobbered. And also keep in mind, America's credit card debts are on the rise still. So consumers in big trouble, and those debts are rising. The interest rates on those debts are rising. Watch out. Consumer spending. This is a consumer-driven economy. I got Dan Hedin is here in the Super Chats. Real quick, Mitch. Dan Hedin, thank you very much for the Super Chat. Guys, all you guys who sent Super Chats while Jay Powell was talking, thank you so much for the support of the channel. And uranium blasting off. Dan, you're going to see a lot of commodities are going to be blasting off right now. And the reason why just about every asset class is probably on the rise right now can be attributed to this chart that I just put up above my head, the U.S. dollar index. The dollar is weakening, and so the value of things denominated in dollars is rising nominally. So that's what we're seeing in uranium. Thank you, Dan, very much. And Mish, I cut you off. Go ahead, brother.
No, that's fine. I think we're starting to see a real softness in the yield, which means bond prices are going up, because we found out last night, Jack actually and I were talking about this, that pensions have an extra $1 trillion out there. So we actually, if you add that to reverse repo, you have $3 trillion of liquidity sitting on the sidelines that will go into bonds first. So I think, I don't want to speak for Jack, that is keeping bond prices abnormally low right now.
Yeah, and I was doing my little post live stream workout this morning. It's part of my little New Year's resolution, my routine. I've been working out a little bit after I do my morning live streams, and I was watching Joe Brown's video from, I think it was yesterday or 2 days ago. Joe Brown over at Heresy Financial. Awesome channel, by the way. You should be subscribed to Heresy Financial. One of the best out there. And on the subject you were just talking about, Mish, he did a video about how hedge funds are more short U.S. Treasuries than at any point in history. And the last time they were anywhere near as short U.S. Treasuries as they are right now, U.S. Treasuries ran like the blazes. And when Treasuries run, the yields come down. So combine this record short among hedge funds and USTs with the reverse repos, all that cash on the sideline, and the fact that U.S. pensions could be about to pile into bonds. We could be seeing a short squeeze in bonds setting up here, folks. We could see interest rates diving to the south. I intend to do a video about this, a dedicated video about this in the near future. But you know what? A very sudden, rapid drop in interest rates, that looks like a panic to Wall Street. Good things don't happen when rates very suddenly dive. Something to keep in mind. Don't know if that's going to happen. I'm still doing a DD. I'm still marinating on that subject. But that was a good segue, Mish. I got Mr. Trees. Hello, Mr. Trees. It's so hard for those trying to buy a home watching prices continue to rise. Well, Mr. Trees, I'm going to tell you, the prices in most U.S. markets, most U.S. locals have stopped going up. Some select markets are still on the rise, but that is the exception, not the rule anymore. By the way, Jack, thanks for saving us from having to watch Meet Kevin live Fed speeches. You are very welcome. And I'm not going to try to do beefs, but I'll just leave it here. Guys, I am going to be very transparent with how I make my money here on this channel, hence the whole speech about how you guys are my product. And I disagree with the way certain other channels approach that subject. So I'm going to stop there. I'm going to stop there. But you can probably, based on this comment here that's covering up my big mug right now, you can probably figure out where I'm going with that. But I will always be transparent and forthcoming with you guys how I make my money. And right now I'm making a little bit of money from Mr. Trees Super Chat. Thank you very much, Mr. Trees. Appreciate that very much. And guys, I appreciate you watching. I appreciate everybody. Thank you so much. I got more stuff going on here, more things. Look, I take so many notes while Powell's talking, so many notes. And I write terribly, so I have to translate my own chicken scratch here. What else we got here? He took a side in the debt ceiling debate. That's big because the Fed values their independence. The Fed is an apolitical organization. At least they're supposed to be. They're supposed to be. All right. The Fed is not supposed to come out and say Congress needs to raise the debt ceiling, period, hard stop. No mention of the CF, that is fiscal policy in the United States. No mention of $31.4 trillion in debt. No mention of the fact that our congressional legislators, the cream of the crop, supposedly the best America is able to produce, has the financial acumen of a drunk 17-year-old kid with dad's credit card. No mention of that. No, we just need to arbitrarily raise the debt ceiling, period, hard stop. All right, so that was low class, Jay Powell. Low class, in my opinion. He did leave it open to more than 5 mentions of core non-housing services inflation. Folks, familiarize yourself with that data point. I'm going to have to go do that. I guess I'm going to have to do a video about what that means and what's in it and what it's been doing, because he gave us the clue. That is when he's going to turn. That's when the Fed's going to pivot, when we see that number start to come down. He said the disinflationary process has started, and that's a good thing 3 times. So this is a good time to distinguish between inflation, prices rising, monetary expansion, deflation, which is money supply contracting, prices declining, and then disinflation, which is in the middle. Disinflation is prices rising slower. So what we have right now, at least in consumer terms, we have disinflation. We still have high CPI. It was 6.5%, I think was the last number. So we still have inflation, but we have disinflation. Prices are still rising, but they're rising slower than they were a few months ago. Now, in some places,
it was 6.5.
Thank you, Mish. Mish is Johnny on the spot with the data points, man. He is right there every time. We're already starting to see a little bit of asset deflation, though. Prices coming down in stocks, prices coming down in bonds, prices coming down in real estate. All right. I mean, not so much at the moment. At the moment, stocks are running, but generally over the last few months to a year, we've seen asset price deflation. Now, the thing that really got under my skin, that really upset me, was when he said we have seen no indication of wage spiral inflation. All right. Wage spiral inflation is
Our boy Phillips.
Yeah, to your boy Phillips. And Mish is going to talk about Phillips and the Phillips curve, because that is one of the tenets of Keynesian economics, and there's some truth to it. When people make more money, people spend more money. Makes sense, right? And I get it. That's fine. But that doesn't mean if you're trying to fight inflation, putting everybody else in the poorhouse is the right way to do it. All right, so he's been talking about the tightness in the labor market, the strong labor market, over and over again. We got to make sure people don't get a raise, even though their cost of living rose by almost 20% in the last year. Negative real wage growth for 21 months in a row. For 21 months in a row, life got more expensive faster than our incomes rose. So all of our lives got harder unless all of your wealth comes from assets, i.e. Jerome Powell and his cronies. Everybody who works for a living, their quality of life went down because of Jerome Powell and because of Congress. All right. So he just came out and said, we see no indicator of wage spiral inflation. In other words, the thing he's afraid of, the reason why he's raising interest rates, why he's trying to kill jobs, why he's trying to drive people further into the poorhouse, there's no sign of it. Well, then, Jay, respectfully, what the hell are you up to? What are you doing? If there's no sign of wage spiral inflation, why are you trying to reduce tightness in the labor market? There is no tightness in the labor market, Jay. Real wages are dropping. If wages are dropping relative to the goods and services you would buy with them, then that means there is no shortage of labor. There is no tight labor market. If there was a tight labor market, wages would be rising faster than goods and services. Maybe then we would see your Keynesian, Phillipsian wage spiral inflation, but it's not happening. And you just said there's no sign of it happening. So what the hell are we doing here, everybody? And this is such a big deal because 21 consecutive months of life getting harder for the average person, while guys like Jerome Powell got more wealthy. That's why. That's why. A free market, that should not be happening. It's so many problems. So many problems. The decrepit conditions in America's cities. Somebody left a comment about Super Chat. Rapid rises in homelessness. Dramatic increases in homelessness. Where do you think that comes from? Yeah, we've got drug problems. Yeah, we have a mental health crisis, and we have a lot of veterans who are traumatized, who are coming back and having trouble reintegrating. All of that is happening. But at the same time, the average person has been priced out of the housing market. We saw another person left a super chat saying, I think it was Trees. Mr. Trees, here, let's put him back up. Talking about trying to buy a home, watching prices continue to rise, right? Hardworking people being priced out of the housing market while the elites get rich because the elites own all of the assets and they rent them to us at increasing prices. And when people can't afford those rents, they end up on the street. So, Mr. Trees, I got a buddy like you, one of my best friends. I talk to this guy a lot, not as much as I should. Kieker, I love you, brother. He's sitting there. I talk to him all the time. Should I buy a house? Shouldn't I buy a house? I struggle. I don't know what to tell them. First of all, I get very uncomfortable when people ask me, what should I do with my money? I don't do that here. I really don't do that. I don't like being asked for money. I don't like telling people what to do with money. I'm perfectly comfortable talking about what I'm doing with my money and why. But everybody's situation is so different. So doing exactly what I'm doing may not be right for you. I'm trying to teach a little bit of that and trying to educate a little bit on that. But I don't know what to tell these guys when they say, should I buy a house or shouldn't I? Because the price keeps going up. But at the same time, we know we're close to a top. Clearly we are. Interest rates rising. These mortgage payments are ridiculous. High prices and high rates. So what do? You sit in cash? Do you eat the cost of inflation? Well, that's what I'm doing with my money. I'm eating inflation, sitting largely in cash right now. It sucks, but I think we're about to see widespread asset deflation, and so I'm waiting. And, man, I got to get off my soapbox. I told you guys my blood pressure was going to be up.
Scroll
ahead,
up.
Mitch.
Mike had a super chat.
Oh, I missed Mike?
Yeah, right around 2:22.
Oh, the timestamp. 2:22 on the timestamp?
Yeah, probably 3:22 for you.
That's why. No, I don't. I'm looking for you, Mike. Sorry, brother. I didn't skip over you on purpose.
So, Robin RC says Meta could be okay. Christmas ads. ... ellipse.
Christmas. Okay. Oh, there he is. Hey, Mike. I'm sorry, brother. I didn't skip you on purpose. 3:22. Mish. On point, brother. Thank you. Meta could be okay. Christmas ads. I didn't really see an uptick in Christmas ad spending, to be honest with you. Maybe political ads, I might say. That's probably, go figure, the one people who have plenty of money to spend are our politicians, right? Hashtag insider trading FTW. Mike, all I can tell you is, living in the Google space, the YouTube space, and I don't even know if I'm allowed to say this or not, but it's hardly, it's hardly privileged information. Google's payouts are way down, which means Google's earnings are way down, which means people are spending less to advertising. Now, it's a little bit of a leap going from YouTube to Facebook, but let's also look at Snapchat, which, newsflash, apparently people are still using Snapchat. I didn't know that. Snapchat still being a thing. Their earnings way down today. I think the spend in advertising across the board is just way down, and that's why I think Meta earnings, which are due out within the hour, folks, probably won't be so good today. Now, I got to put an asterisk next to that. The earnings will probably be bad, but it's every bit as much about what the market is expecting and what the market has already priced in versus what we actually get. You can post terrible, awful, no good earnings that still manage to beat expectations because the expectations were too low. All right, so it's all about what the market is expecting. Anyways, Facebook, Meta, honestly, I think it is a company that's on the way out. I don't really think the metaverse is going to be a thing, or at least not that big of a thing. I think the rebrand was stupid and will probably go down in history as the moment Facebook began to die. And, well, we'll see. Maybe time will prove me wrong, maybe not. But thank you, Mike, for the super chat, brother. Appreciate that. Sorry I skipped over it. That was inadvertent entirely. And thank you again for everything you do for the channel. And I got Mr. S. Henderson. Give me a moment before there he is. Thank you, S. Henderson, for the super chat. Come on up here. Jack's mouse is on the fritz. There we go. Average people should just get more jobs if they're concerned about inflation. Ooh, we're going to have to circle back to that sentence. Haven't you seen the outstanding jobs reports? S. Henderson, man after my own heart. Yes, I'm going to leave that one up, and I'm just going to sit up in my chair here, stretch out that neck a little bit, S. Henderson. Something Mish has been tracking for a while, something Zero Hedge has been talking about a lot. Mish, why don't you just take this one, the households versus the payrolls. Tell us about what you found in there.
Okay, so this summer they started diverging, and at first the divergence was only about 1 million. It's now up to 2.7 million, the difference between the number of people, households, if you will, that have a job versus the number of people that have double jobs. So what we're seeing right now in the numbers is 2.7 million people have a second job. So that is the discrepancy we're seeing there. And if you extrapolate that, that's about 1.5% of unemployment that's not getting counted for because of that double job up.
Yeah, and that's a gap that was growing all summer long. And it did shrink a little bit in the latest revision, in the latest jobs data. It shrank a little bit, but it's still well over 2 million. And a couple of trends there. We've got people taking multiple jobs. We have way more positions being filled than we have people filling positions, which means the the cost of inflation, the negative real wage growth is putting hardship on people, and people are working a second job just to make ends meet. It's not growing the economy. That's just to maintain their standard of living. All right. Now, that's the elite, the ruling class getting wealthier, people having to paddle so much harder just to stay afloat. And, man, that drives me nuts. You know, again, I come back to the comments about the homelessness, the comments about trying to buy a house. There it is. You see it in the jobs report. And another thing we're seeing is we're seeing a slight downtick. We've actually lost full-time employees in the United States in the last few months. We've lost full-time employees. We have gained massively part-time employees, and we have gained massively people working more than one job. That is not a strong labor market. That is desperate people trying to make ends meet. And that also coincides with this blowout in consumer credit growth in the United States, America running up their credit card bills. Folks, this recession debate, it's freaking over. It was over before it started. We've been in a recession for 2 years. I'm ready to call this a depression. I don't care what this muckety-muck behind me says. The average person is suffering economically while they get rich, and they're telling us it's raining. And that is why Jack's got high blood pressure. That is why my veins are sticking out of my forehead right now. Man, you guys are pushing my buttons. You are getting me all kinds of spun up. But thank you, S. Henderson, for that one. I appreciate it. Guys, I'm sorry.
Did I tell you what I had for breakfast?
What did you have for breakfast? Something that's getting more expensive?
Cereal with banana.
Cereal with banana? No eggs? You got it.
No eggs today. I don't have a bunch of ladies popping out eggs out back.
Oh, I got plenty of ladies popping out. That was probably, arguably, the best financial decision I made of 2022 was to buy backyard chickens. That and beans and rice. Best performing asset class in the world, baby. Hashtag chicken life. My ladies making plenty of eggs, right as the price of. I still haven't raised the price of eggs for my neighbors and for my friends. I'm still selling my eggs very cheaply because, now that's just because. I probably could. I'm a lousy salesman. What can I say? Eventually, those prices are going to go up. For now, let's just say I'm beating the market handsomely. Anyways, guys, we've been going for almost an hour and a half. I got a little break. It's going to be a short one, but I am going to be right back because it's 6 p.m. tonight. I am getting together with the awesome folks in my Patreon group. Thank you, Patreon guys, for everything you do to support this channel. I love you guys. Looking forward to talking to you. Bring your best questions. We get together once a week on Zoom for the Patreon folks, and it is a Q&A back and forth. A little more interactive. We talk for about 40 minutes, and we do that once a week. I get a lot of my best DD from the Patreon folks. I get a lot of emails and a lot of ideas from those guys. There is a link down below, should you feel so inclined. Want to say thank you, everybody, very much for all the support, all the super chats, all the comments. Thank you for your time. Hi, Mom. Hi, Dad. I love you guys. Thank you to my Blue Wrenches for keeping things neat and tidy in the chats for this live stream. I know during Fed speeches, the chats get a lot busier. And those mods, they work hard to keep things clean for us. So thank you. Thank you. Thank you, moderator, folks. Thank you, Mish, for your contribution. Anything you want to add before we wrap it up?
No, I think in general, we're looking at a generally up portion here for the next month or two. So take profits where you can. Don't fall in love with an asset.
Yeah. And let's see. Am I going to eat some crow, or is this whole move in the market going to be erased by tomorrow afternoon? Let's see. Anyways. Hey, if I'm wrong, feel free to circle back and say, hey, Jack, you were wrong. And if you're colorful in your language and polite but colorful in how wrong I was, I might even pin the comment. We don't do echo chambers here, folks. All right, guys. Thank you so much for everything. You guys are awesome. Until next time, live small and dream big.